Hi, everyone. Welcome to the Real Estate Private Equity Show. I'm your host, 𝗖𝗣𝗜 𝗖𝗽, and I'm joined, as always, by 𝗖𝗍 Biniaz, my co-host. We're really excited today, guys. We have somebody here who actually lives in Hawaii, and we're really excited to interview him today. His name is Lane Kawaoka.
Well, he's much more interesting than just a guy who lives in Hawaii. I mean,
Well, I just think
so
Hawaii is like our happy place, right? So I'm
yes,
really excited to talk to somebody who actually lives there.
and a guy who's mastered kind of remote investing from where he is. He
Absolutely.
invests all across the U.S. I've been following him a lot. A lot of content he creates is easily found online. So if you're researching a multifamily or real estate private equity related topic, Lane's content comes up there somewhere. He's also big on the educational side. So we're excited to have him on the show today.
Yes,
And
absolutely.
dive deep into
His mind,
his journey as and yeah, can't wait just without getting into it. So go ahead and maybe you can just do a brief
But before I do that, if you guys could please like and subscribe, as it really helps us build our channel and allows us to keep bringing you guys great content and amazing expert guest speakers like we have today. But I want to tell you guys a little bit about Lane, and then we're going to dive really into his background and kind of his start in real estate and so forth. But Lane actually quit his job when he was 33 and he became a full-time investor. Lane, as I mentioned, he lives in Hawaii and he currently owns 2,600 plus units across the US. So August and I believe this interview with Lane will bring value to passive investors looking to become active investors and active investors looking to scale their companies. So we want to thank you so much for being here with us today, Lane, and welcome to our show.
Welcome, Lane.
Yeah, thanks for having me. Aloha, everybody.
Awesome.
Right on. So Lane, why don't we just start off by you telling us about your background and your start in real estate, please?
Yeah, so I started investing in 2009, but before that, I think I'm very similar to at least a lot of my investors. The folks that studied hard in college, went to get higher level degrees, to become professionals, and into some kind of thing where you're working for the man, making six figures, and you're taught this ideal of saving your money, being very frugal with it, putting your money into the 401k or the government or pensions and stuff like that. And if you do that for 40, 50 years and you keep a good steady job, you'll be able to retire one day. And during that time, you have 2.5 kids and you buy a house to live in. I don't necessarily think that that's a good idea, but back then I didn't know any better. And I bought a house to live in a couple of years after graduating college in 2007. So up until this point, the linear path of I became an engineer, started to work here as a construction supervisor, and had this really big house all to myself. And because that's what we're all brainwashed to do. And because I was traveling on the road all for work, a lot of days and months in Montana thinking about this stuff, I had this big house that was only home on like Saturdays to enjoy, and just decided to rent it out. Called up an old property manager and we got a tenant in there. And then at that point, when the rent check started to come in, I started to realize, wow, there's something powerful to this simple passive cash flow stuff. And that's where I started to really get more sophisticated, learn more about it, and things kind of took off from there.
Amazing. Yeah. And but your background as an engineer, you're also involved in construction. So so it starts with your primary residence, renting it out of a just not really trying to cash flow or just out of a kind of a need that exists. But talk to us about the next steps. What followed after that? I'm curious to hear.
Yeah, first rental, I mean, I didn't follow any of the rules that we follow today. I mean, I was in a primary market like Seattle. You don't find cash flow there. It was more of a higher end type of property. I think at the time it rented for like 21 or 2,400 bucks a month. So, today we kind of focus on like the middle half of America, or the lower middle class, because that's where most people live in these days. And but I kind of learned that after a while. I bought a duplex in Seattle in a little rougher area, more B class, and it was a duplex. And then I started to realize, this was way back in 2012, and prices started to really kind of pick up at that point. And we all thought the world was going to end at 2012, 13, 14, and it didn't. 10 years plus later, the market kept on going. But anyway, I started to buy these properties in Birmingham, Atlanta, Indianapolis, these turnkey rentals that you hear about.
And where are
And
you located at this time? You're in Seattle, but you're buying places all the way across the nation.
right, right. So, there's these turnkey providers out there that, I mean, I guess it's okay. I mean, they're supposedly fixing it up new HVAC, new plumbing, new electrical, and some of these guys will even put a tenant in there for you. I mean, if you're a new investor, great way to start out with some training wheels, at least on your first deal. But so I did that, and the damn thing worked. And I was like, okay, I'm selling this one rental property in Seattle and buying like 5, and then I eventually sold that duplex in Seattle. And then around 2015, I had like 11 of these single family home rentals, and I thought, wow, that's a lot of rental properties. But I think we were kind of talking earlier. I think this is the inflection point between just your mom and pop average investor trying to pay down their properties, and folks that are a little bit more sophisticated and understand that these little rental properties are not really scalable, right? Like, so if anybody has this grand idea of maxing out their Fannie Mae, Freddie Mac loans, and 1 in 10 in their spouse's name, 10 in their name, no accredited investors want to do that, or no sophisticated investors want to do that. And I kind of learned this in 2015 with 11 rentals. I had maybe an eviction or 2 every year, and then some kind of big catastrophe that happened every quarter, like tree falling on the house, some kind of flood in part of the house or something like that. And I had property management running these properties because I was remote, and I didn't want to deal with this type of stuff because I was a professional engineer making a pretty decent salary there. So, but all this for like $3,000 of passive income a month, maybe a few $100 per each property. I mean, it's great. I mean, the 20-year-old self would love to have that type of beer money, but what American family or Canadian family can survive off like a few grand of passive income a month? You're going to need to triple that. So now you're tripling that exception rate. Now you're talking about eviction every other month and kind of big catastrophe every couple of weeks.
Okay.
It's just not scalable. And like I think what really popped my eye with like the large apartments and other big value add deals is, well, I said it, you can value add the deals, and that's how you're making way more money, right? A lot of deals, like when you break down cash flow versus forced appreciation or retained equity, it's coming from the value add business plan, and you're just not able to do that when you deal with little single family homes. Now, like the kids on like the internet, these broke kids, they talk about this BRRRR strategy: buy, rent, rehab, repeat. I don't know. It's just too much time and effort, and you're working with like these like broke contractors who eventually just gonna steal your money for you because you have no recourse over these guys. So I mean, more for the accredited investor, right? It's just not a good avenue. And that's where I kind of found myself. And I found my tribe of other high net worth professionals, doctors, lawyers, engineers, had to pay to get into a lot of these groups and, interact with a lot of other higher net worth people. And they're all saying the same thing. They were dumping the little pain in the butt rentals for these larger syndicated value add deals.
Incredible.
Yeah, incredible.
Yeah. So
nobody's got time for that. Nobody's got time, especially busy professionals. They don't got time to be dealing with toilets and tenants, and especially some of the catastrophic things that were happening all the time for you. It's just becomes more of your time's valuable. Well, now you're spending time dealing with all this headache.
Yeah. I will say, like, like there are kids that listen to a crap ton of these podcasts, and they're like, they think that they can go buy these apartments. And I'm like, you guys missed the message. Like, if you're an accredited investor, then yeah, this stuff makes sense. Makes a heck of a lot of sense. But if you're some broke guy with absolutely no experience, go buy a rental property. That's what I did from 2009 to 2015. I was just buying little rental properties. And that's where there's not much to buying rental properties. It's kind of easy. But the experience is valuable. But I think more importantly, your net worth needs to get up to at least $500,000 or over $1 million net worth.
Yeah,
to be able to do what? To be able to actively invest in multifamily or passively?
Actively invest and passively invest. I mean, if you're a passive investor and your net worth is $250,000, $500,000, you're not a credit investor. I mean, you can invest in most of these deals out there. Most of the deals out there are 506B offerings in America. But I mean, what kind of operator is desperate enough to take a large majority of non-accredited investors. Non-accredited investors are kind of a pain to work with. They ask a lot of questions. That $50,000 minimum is a huge amount of change to them. They're emailing you, doing all this, they're freaking out over all little things. And the biggest thing is like, once they put in their 50 grand, maybe 100 grand, that's it. They ran out of money. Like, I mean, I hate to be a jerk, but that's how it is in the pecking order, right? Of, these kind of investments. So if you're a non-accredited investor, yeah, sure, you can get into deals, but is that the one you want to be getting into? It's like you got kind of a tattered record and somebody lets you into a country club. Is that really the country club you want to be getting into? I don't know.
Got it. And would your advice be for someone who is not an accredited investor, just starting out, but they do have some sort of an income, to buy a rental property, possibly utilizing the turnkey option that exists out there? Would that be an advice to kind of get their feet wet into the real estate investing space?
Yeah, I mean, there's a lot of these house flippers out there, and they generate large sums of money, but they pay huge taxes because a lot of that's ordinary income. And we can talk later about the passive income, in terms of taxes. But like they need to get on that escalator of passive income. They need to have their money work harder for them. And with a little turnkey rental, most of them cost like 100 grand. So if you're thinking 20% down payment, little cash reserves, $25,000-$30,000 is what you need to get in one of those. And then at that point, it's a game of you need capital. This real estate investing thing, this is not magic. This isn't venture capital. Like, you need money to invest. If you don't have money to invest, you got a money problem and you need to make money. And part of that is, I know people don't like to hear this, is you have to go make money. And, for a lot of folks I work with, that is at their day job, then wholesaling houses, doing some other stuff with that. And, I just broadly speaking, if you make a professional wage over 80, 100 grand a year, you're kind of more positioned to be a passive investor. If you are making less than that, I mean, probably shouldn't listen to me. Like, I don't know what you can do.
Got it.
No,
Got
that
it.
makes sense.
No, let's keep going down your journey. So you own 11 properties. Now you want to be able to scale. It's becoming too cumbersome. Talk to us about that moment. So you realize multifamily or these syndicated investments exist out there. Do you start investing as a passive investor? And if yes, how do you go about finding the right operator to partner with?
I started I tried to go at it from like the general partner stance right up front. I learned how to analyze the deals, and I was kind of playing that nonsense with brokers where you try and like be their best buddy, take them Hawaiian Host chocolates for about 18 months. At that point, and this is what happens, like very little people are successful doing it. I would say like less than 2 to 3% of people do this, actually get a halfway decent deal thrown their way from a broker 2 years later. So I was kind of getting up to that point, and I had capital from my other investments kind of piling up. So after 18 months of kind of, playing the unsuccessful general partner role, trying to find deals, I realized, well, let me just go into some deals as a passive first, and at least get my ROI of my money instead of having just 100 grand just sit there. That's not what any investor should be doing. But maybe I can like use that one deal as I can trick the broker into thinking that I own 250 units when I'm just a passive in there. Use that little trick of the trade, right? And when you're 18 months into that, spending like a dozen hours every week doing this on top of your day job, you're just trying anything that works 18 months later, right?
Got it. So now you want to get into the space. You get it. You go ahead and make connections with brokers, and you want to be on the deal side, underwriting deals. Possibly you might have even done some site visits, but you realize that, hey, this seems like a full-time job, and the return on investment doesn't make sense in what I'm doing. Hey, let me start investing passively. Are you exploring at this time raising capital, the equity side of it? Are you getting involved in that part, or were you looking to more find your own deal, invest your own capital into it, possibly bring on a couple of investors? Where are you at this time?
I think at that time, like, so I had started the podcast back in 2016, and obviously nobody listened for 2 years, as most podcasts are. But this is about the same time I think we're talking about. So at that time, my podcast was kind of geared towards people or stuff that I was doing. Like I was buying still these low rental properties, semi-turnkey rentals, and that was what I was kind of teaching people how to do on my platform. So at that point, it was still like I actually didn't really tell people I was doing the syndication stuff because I wanted to kind of save face, and like if this didn't work, I could just go back to buying like 50, 60 rental properties on my simple passive cash flow platform. So, but you know what? The damn thing worked, and we got out of those single family homes. We stopped all these like coaching programs with these little rental properties because after a while, I stopped believing in like the turnkey rentals. Like, sure, if your net worth is low, that's the only thing you have to work with. But like, I kind of left that cohort behind. Like it's kind of like there's a blog I used to follow in my 20s called 20 something finance. I unsubscribed to it because it's just a bunch of stupid stuff about like not drinking lattes and stuff like that. I've subscribed more to like 40s and 50s stuff because I feel like I resonate with those type of people more. But like it's kind of the same thing. Like my audience kind of grew with me, and at that point, yeah, I just invested as a passive because I just wanted to like actually have a track record doing it instead of just playing the fake it till I make it game.
Right, right.
So you do that, you invest passively. You're also learning the investor relations side of things in your communications with the operator. I'm sure you're seeing how they're updating you. That's a very important part of learning. I think it's very important to see how these real estate investment firms communicate with their investors. So you're building that track record. Talk to us about your first deal.
First deal. So I actually don't even really remember exactly which one it
One of the
was
first,
because
one of the more earlier ones that
the
you.
one. So like, here's the thing, right? Like I was like, and I talked about like what I did as a general partner, right? It wasn't getting much traction there, but as my passive side, I'm meeting a lot of people, right? I don't have that much money back then, and a lot of these deals you need 50 or 100 grand minimum, like one silver bullet to get. Like I don't have very many bullets, right? I'm like 10 years younger than the average cat of a room with average 40-year-olds in here who did it the wrong way for a decade plus more than I did. And most of them have a net worth $1.5, $3 million net worth. So they have a few more bullets than I do. So something I did, and what I tell a lot of my investors today is like, meet other pure passive accredited investors. And that's what I did. I got to a point where, you try and find the people who are at 5, 10, 20 deals, and you build real organic relationships with them. And I got to that point, and with maybe a handful of them, and I could be like, hey dude, like you're in like 20 deals. How do these things like really work? Like, does somebody run off with your money, or like, does these projections really happen? So that was kind of where, I don't remember what the first deal, but after that, it was like a mirror of, it kind of broke the seal. And after a while, like, just kind of dollar cost averaging in a way. I mean, I did the same thing with like single family homes. Like I bought one property in Birmingham in 2013, and then the thing worked. So like in the next year, I like sold a bunch of stuff and I bought 9 all one time, essentially in like a matter of like 4 or 5 months. Same thing with the syndication deals. Like I get proof of concept and I move confidently through, and I just went into more and more deals. I mean, they're all the same, man. Like guys, like these things are boring. This is why I invest in this stuff. 1970s and 1980s property with a little bit of tired. The management isn't aggressively pushing the rents. You put in like 4 to 5 grand per property. It's all the same. It really. I would say the mistake I made in the beginning, where some of these deals in the beginning were like more Class C properties, and I made the mistake of thinking, well, like, and the Class C properties, like on paper, they look better, but no different than like a single family home that rents for like, that you can buy for 50 grand that supposedly rents for 900. Yeah, you might get a rent check once or twice a year for 900, but you're chasing them, and they're just more harder on the property. Same concept as with the Class C multifamilies. But luckily a lot of those properties hit the business plan projections earlier, and it got out because they're just kind of a pain in the butt to run, and it's like living life on a roller coaster. Like a lot of those tenants, they just don't pay. Like, I mean, we've seen some collections in like the 80%, low 80% range, where typically on like a Class B plus asset, you're in the 90s, the mid 90 plus.
Great point.
Nice. Now, Lane, I have a question for you. SimplePassiveCashflow.com. When you started this is an educational platform that you said that you started, you're like, I didn't get much traction for a couple years. Talk to me about that. You were talking about single family investing, right? Did it start getting more traction when you started talking about multifamily investing?
I honestly don't know. I mean, I think it's just a matter of like, it was like authentic, it's real. And
Yeah. Cool.
I mean, people just told other people about it. Today I break it down to kind of three things, like deals, investing. I mean, I'll do things not multifamily investing these days, but it's all like, that's number one. And the reason why it's number one is because that allows the cost segregations, the bonus depreciation, the passive losses to do the taxes. Now, for most of the folks out there who are high paid professionals, the taxes is the biggest thing. That's where you're going to move the needle the most. If you can lower your AGI from $700,000 to $500,000, a delta of 200, you just save like 100 grand in taxes right there. That's a lot of deals going full cycle instantly. Actually, that's kind of maybe like 2 deals going full cycle instantly. So it's a bigger, like, it moves the needle more, but you can't enact those types of like techniques that most CPAs don't even have a clue about, or maybe they know, but they don't want to deal with it. You have to go into deals first. But to me, like, you got to go into deals where you don't get your money stolen, which I've kind of had some rough ends and kissed some frogs myself. And then the last is like infinite banking, but it's all encompassed with like, there's all this like, and this is what kind of fires me up, right? Like, there's all this like bad financial advice out there propagated by Wall Street and all these things. Be a good little boy and girl and work your day job, invest in this like 401k thing, which it's consistent, but it's consistently bad. And it's because they're taking most of your returns away from you.
And inflation, inflation, it doesn't really work with these lower return type of things that they're just around their inflation mark. But going back to your journey, so now you're getting involved in multifamily, you're investing passively, you're connecting with a lot of investors, you're on the educational side of it. Are you now, at what point do you start raising capital? And when you do raise capital, are you partnering with an operator? Talk to us about that.
Yeah, so I mean, this is kind of where like on the general partner side, I started to get some traction. And then it kind of partnered with the right people who had complementary skill sets. Now, some people, especially like I said, that I worked with in the beginning, I'm no longer working with, because this is the hard thing, right? Like, I'm in the lower rung of newbie fake it till you make it operators. You don't know who you're getting into bed with until you get into bed with them, because 2 things: you don't know if this person is honest, and even if they're an honest guy or gal, you don't know if they're competent, right? Like, those are 2 big things you need. And it doesn't take a rocket science to run this multifamily stuff, but you need those 2 elements. That's a big thing. And, this is kind of where, like, at the time, I didn't have the network of pure passive accredited investors around me to be able to vet people's, those 2 things: competency and, character, essentially. So this is kind of where, we've made some mistakes, but, another thing is, well, if you don't take some swings at it, you never really find your tribe or find your group later on.
Yeah, and you learn along the way. When you partner with somebody, you learn along the way, and you know that next time around, you look for certain key aspects that will work for you.
All right, let's ask you about like currently where you're at, and it's kind of a chicken or egg question. Does it start with the region, or does it start with the operator? Is it the horse or the jockey kind of? Right now, let's say you have capital to deploy with yourself and your partners. Do you go out there looking at a region and then connecting with an operator in that region to partner with? Or do you look at the operators and say, hey, who's performing here? Who do I want to partner with?
Yeah, so this is my spin on the whole loaded question. You know, typically we'll say operator because then it's followed up with, you should invest with our brand because we have a track record, right?
Right.
And on the one hand, it's a marketing ploy, right? But on the other hand, the truth of that line is most passive investors are clueless how to underwrite deals, right? They hear it all the time. Oh, I underwrote, this deal, the numbers look good. Dude, you never got any of the P&Ls. You got none of the rent rolls. What the heck did you underwrite? Like the pro forma projections on the page, that means nothing. Like at least look at what the assumptions are, which is what the numbers run through the spreadsheet to get to that projection. To me, like I think that's the minimum effective for passive investors to understand. What is the reversion cap rate that is used for the assumption at the exit of the deal? What is the rent increases per year? We don't want to, hoping and praying that the rents are going to go up 4 or 5% every year. And then, is this thing going to be occupied 95%? Like things like that. These are key things that move that projections pro forma up and down. So, today we'll hire like a third party underwriter, which these guys they're pretty plentiful out there. And I mean, they're pretty easy to find, these kind of guys, once you're kind of in the industry to kind of, and these guys are super professionals, right? These are the guys that are employed by the big private equity firms out there.
Yeah.
But like for like an average investor, passive investor, they don't have those connections. They don't even know how to underwrite this stuff. They might have owned a rental property at one point, but it's night and day. It's like 20 times more complicated. But there are things perhaps that I think even a new investor who's never owned a rental can kind of key in on. Just like me going to the mechanic, like I kind of like nice cars these days. But like, I don't know anything about cars. I'm the first guy to tell you, like, I just use it to go to the gym and back all day long. But if I want to buy a nice car, what do? Well, I can take it to a mechanic to kind of inspect these certain things. Kind of in the same way as kind of what I'm saying. Like, so in a long roundabout way, I'm kind of saying it's the numbers first. Like if I don't know an operator, I want to look at his numbers first and see what kind of like assumptions he's using or she's using. And at that point, I'm going to see, well, if this person's like, this is the emperor with no clothes on. After that, it's all smoke and mirrors and branding after that. And now I have the cheat, right? I have a pretty big network. So I can just ask my buddies, like, have you heard of this fool? Have you worked with this guy yet? But again, that's why I think like most passive investors can't underwrite deals. They don't have a network. So they have to just kind of go with the leading industries, right? They got to wear Nike shoes or, drive a Tesla or whatever. But I'm offended by that. But like, that at that point, if your level of sophistication is such, then you have to go operator. But I always kind of say, well, get a little educated and you can kind of decode the code and kind of go through the numbers first. And numbers don't lie. People do. People in marketing do.
Absolutely.
Nice answer. He goes to the numbers first. I like that.
No, for sure.
Yeah.
And what are your plans for growth at this stage? Or do you have any plans to get involved on the operational side? Are you more a real estate private equity firm that allocates capital to groups in a co-GP structure? Where do you see yourself as far as your growth and the next steps here?
Well, and like I said, in the beginning, we've got burned by just coming in as a smaller general partner. Now I want to control the whole thing. After being burned, I want to control that capital stack in case somebody's messing up. We pull the plug and we kick them out.
Right.
And I've learned very, very like, you learn by experience, and sometimes those PPMs are written in blood. At least that's how the engineering instructions work in the construction site. Right? There's a point in there where it's like, now I know why you want to have not super majority or unanimous vote to remove somebody. You want majority, and if I can control the pool and how all my passive investors are, which is the entirety, if something is not going right, especially with a nefarious person, that is kind of what I want to the control. And I also want to be in kind of I'm not getting on conference calls and property management calls. Like, we've outsourced a lot of this out, especially like the director stuff. And I mean, as kind of the principal of the company, I've realized that real estate investors are not the ones that are kind of, the starters. They're just entrepreneurs. There's a big difference between real estate entrepreneurs and investors versus real estate professionals. Real estate professionals go to school for this type of stuff, and they go work for big hedge funds, private equity firms. There are things that the professionals that we have, I wouldn't even have a clue. And I'll be the first one to say that. We hire professionals. And when I mean professionals, like, somebody who's worked in the trenches, they've been a property manager for 5-10 years. It's not the best of jobs, but they've kind of stepped up to more of a director role, maybe even ran their own property management company. That's the person I want to be in the operation seat, not me.
Somebody who has the experience, who's been there, done that, and can really, really.
Yeah, I mean, it's like, I want to be a doctor tomorrow, right? The doctor's is like, yeah, screw you, that ain't gonna happen. I guess anybody could be an engineer technically, but it's like, but we all say like, oh, we can just be investors. We're just gonna go buy 100, 200 unit apartment. Like, all right, well, yeah, you could, but did you go to school for this? Did you work under a tutelage, apprenticeship of somebody who was senior? For
But
some
just
people,
quickly to separate those things. So when you get involved in a project, in a syndicated investments, you come in there as a partner, as a lead GP, or one of the lead GPs. You bring on your group of investors, the professionals that you hire, property management firm. If it's a construction contracting company, you make sure you hire the professionals. But amongst here, there's also the operating partner, which is the asset manager, the acquisition director person. What do you look for within that partner? Is it, again, track record? Is it to see that they have done deals in the past? And also, is this partner required to bring on a portion of the equity? Are they bringing on investors as well? Talk to us about.
Oh, I guess, yeah, I should have clarified. Yeah, when I mean like bringing these people on, we're not talking about the property management staff. That is vendors, that is third party outsource. What I'm meaning, these key staff people, they are in-house too.
So you're not partnering with operating companies. You're not partnering with ABC syndicator.
No, I've been burned by that.
So you're syndicating the deals yourself as a lead GP. You bring on your investors, and then internally you have an asset manager, an acquisition director who looks at deals and vets deals, has a deal flow. You got your asset manager who oversees your contractors, your property manager, your renovation company, and you're there yourself as one of the leadership members, kind of overseeing everything.
Right. And I mean, but part of the reason why we can do that is, we've got over like 1.2 billion dollars of assets, right? So this has all happened maybe in the last few years where it's transitioned to this.
Right. Nice. And what regions are you located in right now, Lane?
I like Phoenix. I like Houston, Dallas. Texas is great. We've kind of gotten lucky. We started in Huntsville, Alabama, which is kind of a tertiary market.
Okay.
But I'm not really in like Florida or Carolina. I think the big thing is like just focusing on like a few, because a lot of what drives this is you need to have those broker relationships in a few areas, and you can really only take so many people to lunch figuratively too. But also, there's a kind of a tipping point. We've got over 8,000 units now. Really, the key is to getting above 1,000 units into one area. Like, once you get over that unit count in one area, you can really start to see those synergies. Because, I mean, it's not so much from like a material, usage, or this property is going to borrow a ladder or some shingles from this property, but it's more like if a property manager goes down, which happens quite a bit. I mean, had to fire quite a few people over the years. but that person can go over, mentor, assist, if anything.
Got it. Got it. Great.
Awesome.
Now, I was on your website and I noticed a picture
Yeah.
of you with some known people that we know. Now, briefly before that, you were discussing how you immerse yourself. You're always surrounded by, try to surround yourself by, other stakeholders in the space, also accredited investors, doctors, lawyers, and what have you were talking about. But we realized you also immerse yourself in a picture. So we want to kind of learn more about that picture. Was that a mastermind group? I think you were with 𝗖𝗽 𝗖𝗽, Michael Blanc, 𝗖𝗽𝗶𝘁, Paul Moore. It was an all gang of you guys. What was that mastermind, or what was that event? Tell us more. We'd love to learn.
I don't quite remember what it was. I mean, we're always kind of in the same places. Like we're kind of in the strange space, right? Like, I mean, institutional operators who've been around pre-pandemic, they typically have like 5 billion plus in assets. What do you do when you're kind of smaller than that? Well, that's kind of where we are. We're like at 1.1, 1.2 billion dollars in assets under ownership. And it's like, you gotta surround yourself with like your tribe and the people that are at least kind of in your threshold, right? Like I kind of do this as the same thing with like I'm in another group, non-real estate focus at all, but like there's a certain level of like revenue requirements to get into.
Like a Tiger 21 kind of type.
Yeah. Although that one's more for like passive investing. You need $10 million minimum. I think it's going up to like 20 or something like that. But like I don't know. I got lucky kind of initially, like for some strange reason, I just paid a lot of money for these mastermind groups, even though I thought it was crazy at the time. And then like I meet these people and it's like the level of synergies are so like high. And what I appreciate today is like by joining these groups, at least I kind of know, well, either one of the two things is possible. Either this person's kind of on my level and we can dance and we can talk about things that nobody else out there talks about, or this guy's completely full of it and just blew $25,000 a year. I'm going to find out pretty quick if that's the case. And not many people do that when it's 25 grand a year. And, I think at this point, like it's social too. Like, I mean, that's why I'll kind of join some of these groups also.
That's really nice because the multifamily fraternity it's kind of like a small space. Everybody kind of knows everybody, everybody's friends. It's really, really fantastic.
Yeah,
actually. We've all kind of spoken on each other's shows.
Yeah, my biggest fun is just guessing people's heights. I'm always wrong, always.
It's
so
crazy.
I was looking at people like, I wonder if this person on the left.
And then
Oh
you
my
meet
God,
them in person, you're like, holy
you're
man.
6'4". I thought somebody was
Yeah.
tall and they're short. So it's fun.
Yeah, it's definitely fun. But
Fun
it's really cool
times,
that you
fun
join these
times.
masterminds. So anybody listening, definitely join masterminds because it's so cool that you're in that room with like-minded individuals. And
Yeah.
I've heard hundreds of stories where it's just
what
worked
is your
out amazing.
What is your favorite one? Like, if there is one mastermind
Yeah.
group, somebody who is, let's say, a syndicator but smaller, kind of, just have a few hundred doors under management, what would be the best mastermind group to join in your opinion?
I don't know. I mean, I'm not a huge fan of like the real estate masterminds. I gotta be honest. Like they are a lot of just posturing and like, I think I've gotten the most value of non-real estate type of mastermind groups. And I think like that's what you see it. Like if you got a podcast, make a freaking mastermind, right? Like, I mean, I've made one. It's a little bit different, but like I think there are a lot of like, there are kind of two different masterminds out there, right? The ones that are led by a guru, which are typically not the greatest ones to join because it's just a money grab from their exposure and their brand. You want the good ones, you find the ones that's led by somebody who truly is passionate about the community and creates the structured environment for collaboration amongst people who are not just chasing fanboys, right? That's it I get. Like a lot of these groups are just kind of fanboy chasing groups. I'm in like another like kind of e-commerce mastermind group. The person leading it is just kind of relative nobody. they're not doing it for their brand and reputation. They just like to hang out with other people in the internet TV space. And it's, people will say like, this is the best one out there versus all these other, like, and if you, I don't want people to do it because it'll probably fill up your Facebook, like, internet feed with all these advertisements, right? But if you like type in like Russell Brunson and all these things will start to pop up. And all these kinds of mastermind groups are kind of what I call manufactured groups. And I mean, you might meet some good people in there, but I don't think the intention or the curated experience is kind of what you're looking. There's always something, it's hard to find these groups. I think that's the hard thing though.
Right. Right.
You know?
Got it.
So I've been known to jump around a lot. Like,
Yeah.
I'm definitely a mastermind group swinger. I'm not paying for no lifetime membership. I'm in there for a very short period. I may only go to one meeting and peace out after that.
Okay.
Got it. Quick question for you. Just last question about items we were talking about before. Do you partner with other capital allocators to come on board and invest and bring on capital to your deals and bring their group of investors and then partner with you as a co-GP?
Not really. I mean, I can raise the whole entire thing, and I think when my lawyer tells me it's a little bit of illegal, so I try not to go there.
For others to join and what have you too.
Yeah, because like, to me, my interpretation or what I've been told is there's no non-sponsor based compensation. Right? You can't just raise capital. Now, if somebody has a broker dealer license, like Series 66 or 7, yeah, it's fair game. But like, I mean, if you don't have that, you've kind of lost that safe haven protection. And the last thing I want, I mean, I don't really need to do this for money anymore, but the last thing I want is SEC to come after me and my family. That's the last thing I wanted, you know?
Yeah, absolutely. Now, Lane, my bad. I have this thing in my mind, but I have a question for you. What would be your advice that you would give to an investor who wants to start investing in real estate private equity?
Well, I mean, you got to figure out where your net worth is, right?
Yeah.
If you're still under a certain threshold, I'm not going to say exactly where that is because I don't know, but certainly if you got a net worth under $250,000, $500,000, you got a money problem. Go make more money. If you don't make $100,000 a year, you got a income problem. You got to make more money. I'm not there to help you, but if you make over 100, 200, $300,000, then it might be a personal budget issue, right? Like most of the folks that I work with, like, it's really like what you save at the end of the day, your net.
Yeah.
I mean, a lot of guys are like, they make 300, 400 as a household and they save maybe 50 to 90,000 a year. It's kind of average, but there are some like folks out there that are, they're making like 100 or 80 grand a year and they save 70 grand a year.
Right.
I mean, that's just how some people live, like, good for them, right? Good for them. It doesn't matter what your income is. It's all what you net at the end of the day. I mean, and that's what initially got me off the ground, right? Like when I was in my early 20s, I was saving like 80, 90, 100 grand out of my paycheck every year because I was living on the road, living in a bunch of hotels, not spending any of my own personal funds, just sticking it to the man that I work for by just like 5-figure expense reports every month. It gets old, but that's kind of my attitude on life is like, you got to grind, you got to put in a short period of concerted effort, and then you apply it to passive investing that compounds and maybe get a little value added there. That's how you make something big. But I think too many people out there, they think they should just like pop in and just like multifamily investing, real estate investing. It's all great, it's all good, but it's not like a magic bullet. This isn't like some kind of venture capital thing that can go asymmetric 20x, 50x, 100x. Because something like that will probably fall on its face 95% of the time. Real estate is very stable. It's a hard asset, but you're not going to get those crazy asymmetric returns. If you don't have any money, you may need to go into this venture capital type of stuff and take some moonshots out there and try and hit some home runs. You'll probably strike out a lot, but real estate is for people who, understand the taxes and need the tax benefits and just want to preserve capital at the end of the day, I think.
Well said. Well said.
Perfect. Awesome. Let's get to the
Amazing.
next segment of our show.
Yeah, let's learn a little bit more about Lane, the 10 championship rounds to financial freedom. Whatever comes top of mind, here's the first question. Who is the most influential person in your life?
I don't know. I don't really idolize anybody. I think everybody has their own faults.
Right.
I don't know. I'm not going to say my parents, that's for sure, because they invested in the 401k and they kind of think very linearly. I don't know. I like sports and like athletes. I like guys that kind of play part of the team, and
Nice.
I like Scottie Pippen. Get to
Yeah.
do everything else Michael Jordan didn't do.
Okay. Okay. Right on.
Cool.
I like that. There we go. Lane, what's the number one book you'd recommend?
I'm not a big book reader. I'm trying to be more. I would say as far as like real estate investing, Millionaire Real Estate Investor, that's pretty much like, I think, a good foundation everybody should read. After that, stop reading books, go into it. Something more like lifestyle, like business books. I mean, yeah, I've been told I read too many nonfiction books. I don't know, you have to come back. I'm trying to read some more of those.
Sure.
My next book that I'm trying to read is, let me get it right here. I'll have it in. How Will You Measure Your Life by Clayton Christensen.
Okay. I haven't heard of that one. How will you measure your life?
It's kind of the age-old question that I'm trying to figure out. It's like, when is enough enough?
Right.
We all could just die with some terminal illness in 6 months. How can you align with what you're here on earth to do when you don't have to trade your time for money anymore?
Right. That's $1 million question, right?
Yes.
Okay, we gotta read that one. Okay, Lane, if you had the opportunity to travel back in time, what advice would you give your younger self?
Ooh, I would probably tell myself like, I would say like the second year after I bought my rental, I would try and pay down the mortgage. I'd probably like go to the park. I remember walking to the parking lot. I'd probably show up and like slap my hand. I'd probably tell them like, don't do that. Debt is good, right? Just get as good debt as you can get your debt service coverage ratio over 1.25.
Yeah.
And don't invest in those little rental properties. Don't buy 11 of those rental properties. Just buy a few to get your feet wet and get some knowledge, and then go to the big apartments after that as quick as possible.
Nice. Okay. Okay. Now, what's the best investment you've ever made?
Best investment, I would say like kind of signing up and like getting into like mastermind groups and
Nice.
paying for like consultants along the way. It's really kind of helped me build the skill sets and the networks necessary. Today I still do it. I know it seems to be a waste of money, but I just paid a guy to be my health coach to help me like get more healthy. So he'll like text me encouraging things and he'll keep me accountable.
That's amazing.
I've hired like a life coach too. He's really expensive and he tells me I don't have any feelings. But we'll see where that goes. Or maybe I'll just read this book, How Would You Measure Your Life?
Hold on a second. Your life coach said what? You don't have feelings?
I have no feelings.
Oh, geez.
Wow, you have one laconic life coach there.
It's a trusted critic, maybe. He tells him how it is,
Wow.
He's like,
Yeah.
He's definitely
he's
not
trying to bring out something in
he's
you.
definitely not a yes man like most life coaches are.
Yeah,
But
that's a good life coach to have. Somebody who tells you how it is or what they believe, and then it makes you grow.
Yes.
Yeah, he's very like non like woo ish, very pragmatic. And I think that's what I've kind of learned, like myself included, right? Like I'm very passionate about this stuff. If somebody's the right person, I dive in and I want to help out this guy because this is something that I've kind of struggled with myself. Is like you're stuck in this crappy job you don't like, and you're just investing in this garbage, and you'll never get anywhere. I mean, yeah, you'll get to retirement in 50 years, but there's always like a shapeshifter that like you meet that teaches you this stuff. Trouble is, nobody who knows this information is going to do this stuff for free. That ain't going to happen. People always ask, who's your mentor? Who's your mentor? Ain't no mentor going to help you do it for free, right? You got to pay for this type of stuff.
Yeah.
And there are parts of like my life that aren't as strong financially, right? So like I identify those portions and I figure out, well, who is the expert that I can hire to kind of get me a little bit more balance or help me augment that part. And then sometimes I take some chances, sometimes I spend some money and thought, well, that was kind of a waste of $5,000, but I mean, those are kind of like asymmetric investments, I guess.
No, absolutely. And people think that, coaches and all this stuff is just for business, but there's health coaches, life coaches, trainers.
I don't feel
It's
that
very
bad
important.
spending the 5 Gs on the guy who was going to help me find investors on LinkedIn.
Yeah.
But, all right.
Awesome.
Oh yeah, those guys are kind of a waste of time, I think. Yeah.
Well, you live and you learn, right? Now, here's
Yeah, it makes for a good joke after, like some of
Yeah.
these guys, like, and then you realize, well, there were like 20 other guys who did it. Kind of scratch your head.
Yeah.
Absolutely.
Maybe this is the business I should be getting into.
Yeah, 100%. Now, that leads me to my next question. What's the worst investment you've ever made, and what lessons did you learn from it?
I mean, worst investment I've made. I mean, I've lost. My first deal as a passive investor. Actually, I didn't mention this. Technically wasn't my first deal. It was like a deal. It was in 2013 where I knew nothing about syndications.
Right.
I invested with some folks and I just went off like a referral from like some self-directed IRA company. And now I'm like, why the heck would I listen to a self-directed IRA company? What the heck do they know other than the fact that they're getting some kind of kickback on the side? So that person, and then I found out later as my network started to expand shortly thereafter, yeah, that dude, he scams everybody, and I'm like, well, duh, I should have just done a Google search on him. But basically, I mean, lost all that on that one. I mean, I kind of have an article on it. I try not to remember it, so I wrote it down so I could forget it personally, but it's at simplepassivecashflow.com/fail. But yeah, we laugh about it now because
Was it a multifamily syndicated deal?
No, so this happens a lot in like the single family home world because there's just like I don't know, it's just more of like all over the place and that stuff, especially these blind pool funds. These blind pool funds are like notorious for nefarious action because there's no transparency. And what typically happens is the house flipper who's in charge of the stuff gets behind. They feel like they can catch up, but then it ultimately catches up to them. But in this case, I believe it wasn't. I don't think there was good intentions from the beginning, and I think it was like an engineer, like money grab, and then kind of just let the assets waste away. As he puts it into an LLC, and sails off in the sunset. And that's why like you see a lot of these deals in the single family home world of like debt funds. Like, well, what's the collateral? Like collateral is no collateral. All right, well then, thank you. See you later. Not interested, right? But a lot of investors do this type of stuff, and there's this huge market of people who will like, hey, we got this house flipper, like we get 12%, and then they're making like 2% and kind of just upcharging. But the house flipper who's doing it is actually a complete newbie and really should be paying like 20%. So there's a lot of that type of stuff going on in like kind of like the lower rungs of the mom and pop investor, especially like the local real estate club, troughs. It happens quite a lot. But yeah, in my case, I think this guy did it before, and that's why my inkling is like kind of knew what he was doing, and put everything in an LLC, and there was no personal recourse to it. As opposed to when you buy a large apartment, like like the bank is going to come after you, right?
Lane, that was I wouldn't even consider that a bad investment because you were defrauded. That this was a malicious attempt to defraud you and other investors where there might have been projections shown. So it's difficult not to make those mistakes because it was so well organized. At times, sometimes people invest in some new starting company or some concept they don't fully understand, and then they, in retrospect, it wasn't a good idea. But I'm guessing that in your case, this was an actual attempt to defraud you.
Yeah. Well, I mean, I'm going back to that earlier question, right, about the operator or the deal. If you're investing in like semi-stabilized assets, or just, you can make the argument for real estate in general. The reason why you invest in real estate is it's a real damn thing. It's a hard asset that holds its value. It's really hard to lose your money. If you lose money, there is a high chance of like some negligence or just like somebody like stealing money.
Yeah.
And I don't know what the numbers are, but I'm just kind of just guessing in my head, like 80% of the due diligence is on the people to mitigate the bad deals. And that's why I say like my kind of my failure in this case was like, just if I vetted the person better, which at the time I could give myself grace because I didn't know anybody, but like if I would have, like, or this is why I tell people, like, people bring me deals all the time. They think I'm some kind of like deal inspector for them, which I'm not, right? If like just send me emails, but I do look at them sometimes. And I'm like, well, and I have a cut and paste, and it's like, how do you know this person?
Yeah.
You know, or how do you know anybody who has invested with this person in the past? And most times it's like, no, I just saw them on internet, you know, or this Facebook group. I'm like, all right, well, chuck that stuff in the water.
Yeah.
I don't want to see it. You know, you already know what I'm going to say, you know, and that's the lesson learned. It's like, you only work with people you know, like, and trust. And that's, to me, that's like the gold level standard. Now, in my mistake, the critical mistake was that the property, or this so-called like this self-directed IRA company, and they seem to have a reputation, just some dude that probably is getting some side kickbacks as the salesman or something like that, or maybe not, like, but it's like that one guy who at the point of referral, did he invest with these people? Heck no, he's just a sales guy who doesn't have any money. Why? That's not the gold level standard of what, like, for me is like a warm referral.
Right.
And you don't get warm referrals unless you build relationships with people.
Build that know, like, and trust. We always talk about that here at CPI.
Great advice. Great advice.
Okay, next question, Lane. How much would you need in the bank to retire today? What's your number?
In the bank liquidity, I don't know, like 50 or 100 million or something like that. I haven't thought about it. I need to read this book. How will you measure your life? So I can backwards engineer to this number.
Nice.
I do tell like my investors a lot that, like, you know, if you have $4 to $5 million of assets, not necessarily liquidity is better, but 4 to 5 million of assets, you know, you should be able to live up that so-called 4% rule for the end of your life. And most people have 2 to 3 kids. You can typically create a inevitable or a everlasting income stream of like 100+ grand a year for each of them, who will probably become nincompoops and, you know, like maybe get into drugs. Hopefully that doesn't happen, but that sum of cash is enough critical mass to kind of, for most people, to get to that level. For some people who grasp upon like some kind of philanthropic bigger impact goal, you're going to need to get that over 10 mil in equity. But I know some people that we've done some past deals with where I think the goal was like 500 million liquid. Now, I don't know what the heck you're going to use that for, which is why I kind of jokingly go by a fraction of my response. But I don't know, it depends what your lifestyle is, I guess.
Yeah. Right on. Okay.
Absolutely amazing. One of the main kind of inertias that push me into this business is watching others who've done so well in this space in such a short time. Somebody that I watch closely, they're worth well over $300 million, and they just had a regular job prior to getting involved in real estate private equity. But
Yeah,
awesome. Let's
yeah.
get to the next question.
Okay, Lane, if you could have dinner with someone dead or alive, who would it be?
Ah, I don't know. I mean, I'd like to know, just have some dinner with people in my little inner circle group. I wanna, I'm not a big fanboy of anybody, or try not to be. I mean, everybody's got their faults, and everybody's got like a kind of a two-face kind of a thing. What you see on one end, it's very different from the other. Um, that's just kind of my life is like, from the relationship side. It's just like, what do I want? I've written this down. Well, I just want to hang out with the people that I trust, right? And
Yeah.
it's not, some people call this like your inner 10 or inner 50, or maybe it's an inner 100. But that's all I kind of want. Not every day though, right? Like, I'm kind of an introvert, and I like my own time. But like,
Alone time.
yeah,
Well, what's your marital status? Like, this is not one of our 10 questions. Just quickly, sorry.
married. Yeah,
You're
got a
married.
kid.
You have
Okay. Okay.
one kid?
Yeah,
Oh,
Okay.
yeah,
Amazing.
amazing. Girl or
Amazing.
boy?
girl.
Oh,
Okay.
amazing. Good for you.
Amazing. Amazing. Okay.
Okay,
Next
okay,
question.
we're just about done with our questions, but if you weren't doing what you're doing today, what would you be doing now?
If I weren't doing this, I'd probably be stuck at my day job that I hate.
Right.
So I have a lot of gratitude for what I do, and every day I probably should. Um, I think to myself, it's like, I don't want to go back.
Yeah.
I would, yeah. Now that I've tasted the forbidden fruit of kind of working in my own passions, and seeing how quickly I can get things done without having to do that 8-hour rigmarole every single day, it's just, I don't want to go back, and I have a lot of gratitude for that. And yeah,
And and you live in Hawaii, where you can literally go to the beach and enjoy
And he
the sun,
educates, and
and
he's.
you
And when
educate.
asked who could you have if you had dinner with anybody dead or alive, he says, "I just want to have a dinner with a group of my friends
That's
and close people to me."
amazing.
So like
yeah.
that talks to you about
Amazing.
what I'm very interested to hear his answer to the next question.
Book smarts or street smarts?
Um, I'm not a huge fan of like college and education. I mean, I got a master's in construction management and an industrial engineering bachelor's. I'd say so. My answer is kind of twofold. So for most people are not entrepreneurial minded. They need to have somebody tell them exactly what to do.
Mhm.
Perhaps the school system creates this, but I kind of feel like it's kind of like in our world, like, we're a tribe-based society. There's certain leaders, majority followers. Um, most people are good foot soldiers, and some are really damn good ones. And most people need to kind of work for a larger company. And if you don't, and look at these larger companies, they do such kind of great things because they channel their work energy and expertise of so many people. And I think from that perspective, school smarts is good, because school smarts creates the foot soldiers for that. That said, for myself, like, I don't really use any like of the school stuff in my prior engineering career or now. A lot of it was kind of learned on the job, working with a Fortune 500 company on how they did things professionally in different, accounting systems. So like how we write emails, or how we interact in meetings. That was where I learned a majority of my type of stuff. I don't know anything. I don't use anything engineering wise or what I learned in college today. So it's good and bad. I don't know. I think it depends on who you're working with. And I think for my kids, if they are I think the majority of the time, maybe 90% plus time, I don't know where I get these percentage from. I just make this stuff up. But like the majority of the time, the subject is going to be more like employee based, right? It's a very rare type of profile where you're going to be an entrepreneur. even more that you're a successful entrepreneur, as most entrepreneurs today are just dudes who can't find jobs. Right? We're not talking about those guys, the entrepreneurs. We're talking about the people who really have it. And I think like the person who's going to make a huge amount of headway in the world is going to go through a formal education, go to that grind mentality, get the network through that education, whether it's prestigious school or private education, go work at a company, a Fortune 500 company, Fortune 50 company, learn the systems. And I kind of did that myself. I think both started entrepreneurially. The problem is not many people have the capital to do it. You know how many like petroleum engineers I have sit around at lunch thinking that they can just go make their own well and make a lot of money. Yeah, they probably have the know-how to do it. They may not have the business sense or the connections to do it, but they certainly don't have the money. So if you have the money to power this very talented and professional who has gone to the 10,000 hours of professional development, man, things can really jump up, especially if they have the network that they went through a prestigious school.
Absolutely.
But what do I know? You know, I don't have kids, but that's just my outlook.
Great answer.
Yeah,
Great
great
answer.
answer.
Really enjoyed that.
Last question, Lane. If you had $1 million cash and you had to make one investment today, what would it be?
Depends. If I had over, $110 million, like if I'm that scale, I would just put that money into infinite banking and just rock on it, 5% tax free. If I only had $1 million, I'd probably be putting that in stabilized value add real estate, or maybe a little bit more riskier value add real estate base, because that's what I know. I'm not a huge venture capital person. I would like things that making money now or backed by a hard asset. If I was like $5 to $10 million, I don't know. It could go either way depending where you're at, I guess.
I like your answer there. Infinite
Amazing.
banking. Nice. Awesome.
Awesome, man.
Lane.
Hey, we really appreciate you coming on and giving us your time and, giving us all your knowledge and wisdom. Really appreciate your transparency.
Yeah, really
and
appreciate
we're
it.
sure that our audience will get a lot of value from listening and watching you.
And really quickly, what's the best way that people can reach you, please?
They can check out podcasts, Simple Passive Cash Flow, Passive Real Estate Investing, or they can go to my website, simplepassivecashflow.com.
Amazing. Thanks for being here today, Lane.
Thanks.